Welcome to this episode of Next Exit. I'm here with Son Choi, multi-time CFO, both in the private equity and VC space, as well as being a founder and an angel investor. Hi, Son.
Hey, how's it going?
Good. It's good to have you here.
Yeah, thanks for having me.
No worries. Really excited. So to kick things off, it would be great to hear an introduction to you about your career and your background.
Sure. Currently, I'm a consulting CFO and a startup operator. I primarily work with early and growth stage B2B SaaS companies. Previously, I've worked in investment banking, and after that, worked in corp dev for a little bit, and then have worked for startups for the past 12, 13 years or so. Like I mentioned earlier, today I work as a consulting CFO, so I primarily come in during moments of inflection in the companies, whether the companies are either fundraising, preparing for an exit, or maybe they're building out their financial stack. I've had the opportunity to work with companies that have exited to strategics as well as private equity, and I also do some angel investing on the side.
Fantastic. That's great to hear. So you're as you say, consulting CFO, and you've worked at many companies in a relatively short period of time. When it comes to financial reporting, forecasting, and other KPIs, how would you look at rolling out a system from scratch? Or how do you look at doing that in your current role?
Yeah. I think there are phases or steps. So the first step when I join a company is to get the books right. So ensure that the historicals are accurate and ensure like revenue, expenses, they're all categorized correctly. Because if your historicals aren't right, then your forecast will probably be wrong. After that, I like to build a financial model. So a 3-statement financial model where there are a few different toggles to be able to have different scenarios from there. And then after the model is good with historicals and the forecast, then figure out what KPIs we should be tracking. And then after that, one of the most important parts is just figuring out that reporting cadence and how to potentially automate getting those KPIs set up, because it sucks to manually update it. Some of the companies that I work with, we just have myself update Google Sheets manually each month, and that sucks. Whereas some other companies I work with where they want to invest into a good KPI tool, then usually it's just magically done, and that's always good from my end.
Yeah, absolutely. So you said you normally focus on the earlier stage of the growth curve. It sounds like sorting out the finances at a more basic level is a pretty regular challenge.
Yep, for sure.
Yeah. Okay. And on the topic of KPIs, what KPIs outside of the classic finance KPIs do you normally focus on?
Yeah. So obviously you have your ARR, net new bookings, expansion, upsells, as well as churn. And with the churn comes your gross renewal and net dollar retention rates. From the efficiency side of things, try to look at sales and marketing efficiency ratio, how much you're spending in sales and marketing to acquire a new ARR. And then your burn ratio, how much are you burning overall cash burn to acquire that new ARR? And then besides that, I guess you have your CAC paybacks as well too, to understand how efficient you're being with sales and marketing. So a lot of go-to-market metrics, which I don't know if it's a good or bad thing. And then you have, I guess, super high level, because a lot of companies are being very efficient today, right? ARR per FTE, and trying to understand how much ARR we can squeeze out of each of our FTEs that we have on board. Yeah.
Love to hear it. So when you're operating in a company and you're looking from the other side of the table, what does the potential acquirer look for in the business in terms of those metrics, both on the go-to-market side as well as, the efficiency side?
Yeah. I think some of the times it might vary if it's like a strategic versus like a sponsor, like a PE. But I think some of the things that both of those types of acquirers value are, one, like clean financials. And that's like the very basics, right? Ideally, everything's GAAP compliant, with revenue being very clear, reconciliations, and like no surprises in the financials. So I think that's like table stakes there. After that, potential acquirers definitely want to see that predictable, repeatable growth. So they want to ensure that your net dollar retention is greater than 110%, CAC paybacks less than 18 months, gross margin looks good, like greater than 70, 80% for sure. And then also trying to understand the operational leverage to, if you're not profitable yet, that you are on a path to profitability. And that rule of 40, I think, is pretty important. I think that's come up a lot more recently than before the ZERP era. So rule of 40 in terms of how much are you growing year over year, and adding that growth rate to the your net income profitability. And then if you're closer to 40 or greater than 40, then you're in a pretty good state. And I think the last few things, hopefully you have scalable systems. So you're able to close the books really quickly, and your financials are in a pretty good state where maybe your ERP is in like you're using an ERP that's pretty it's caught up with the times, where it's like, I don't want to crap on NetSuite, but I'm sure you've heard horror stories about NetSuite and how long it takes to get things up and running. Ideally, you're on like a good ERP where it's really easy to get your financials and get clean data out of there. And then the very last thing is just, hopefully you have a low customer concentration and a clean cap table. If you have a client that accounts for 60, 70% of your revenue, then that could be pretty scary. But obviously, given good context there, then investors should be able to be okay with it.
Yeah, absolutely. So I guess assuming a company's got all their financials in order, everything's clean, the revenues of a decent quality. Outside of that, what are the main pitfalls to avoid when running up to an exit?
Yeah. So some things I can think of is probably the opposite of what I just said. So maybe messy books and late close. If your numbers are weird, or if your numbers don't pass the sniff test, then that's when they specifically, like PE growth equity folks, will dig in some more. Like they live and breathe numbers every day. So an acquire from like a PE would be a lot different from a strategic, where the PE would probably be a lot more numbers driven, and actually like dig in and be calling you or be paying you 2, 3 a.m. in the morning because they're still going through all that crap. So just ensure that your numbers are good, and making sure that they're buttoned up will be very important. Also, don't paint a too rosy picture, right? Like if you're only growing 50, 60% year over year, but then in the forecast you show doubling growth to like 120, 150% year over year, then they're going to understand like that you're not being truthful there. And unless you don't have a good reason as to why growth is going to explode once they buy you out, then they're probably going to call BS on that. Last pitfall, I guess, could be potentially misalignment at the board level. This is more higher level, but if your board isn't aligned on your exit strategy or your valuation expectations, then it can definitely derail a process or maybe just delay it at the very best case scenario. So just ensuring your board is aligned in terms of what they actually want for the company, not only from like an exit strategy, but also from a dollar perspective too, or valuation perspective. I think that's pretty key. And it's something that maybe won't be blatantly obvious in the beginning of going through a process.
Yeah. So you mentioned there people having forecasts and projections that are different trends or more optimistic trends than what they had in the recent past. You've worked in both trade exits and PE exits. How can you dig into the detail there of what the differences are and on the process and what they expect to see and what they'll let go and what they won't?
This is probably pretty obvious, but strategics, they're most likely focused on the product fit with their actual company and then the integration with the team. Obviously, they'll pay a premium for any strategic synergies that they could possibly be in there. And they're going to dig in more into your roadmap and your customer base versus like the profitability. So during strategics, what I've seen, and I'm actually going through it now with one of my other companies, is the CTO and prod and eng group will play a lot bigger role. Like with PE, the CTO and the eng leaders, they definitely play a big role, but with strategics, usually the CTOs and the eng leadership will take not a backseat, but actually be in the front seat and being able to talk about the product, how that could potentially fit with the current product strategy of the strategics, and then going through the product roadmap and ensuring that it makes sense from that strategics acquisition perspective. Does that make sense?
Yeah, absolutely. So you mentioned before you worked in corp dev. Can you tell us about that?
Yeah. Oh, sorry for that last question though. On the flip side, if it's a PE, like we talked about, they're super focused on the numbers. They want predictable cash flow, and they want to be sure that they can actually come in and hopefully make that cash flow and make that revenue increase a lot quicker than what it has been. So it's definitely a little bit more numbers focused versus that actual product focus. They'll probably bring in like a expert or like a consulting firm to validate that the product is good and the technology is good, because usually they don't have that know-how and to be able to dig into the code to see that it is good. Whereas with the strategics, they'll dig in, they'll go into your GitHub and see what's going on, what code you're pushing to the database. Whereas PEs, they don't really know how to do that, so they'll probably hire a third party to validate that the product is good from that perspective. Yeah.
Got it. Okay. And can you talk to your experience in corp dev with that in mind?
Yeah. So I work in investment banking out of my undergrad. Really wanted to work in tech, but I was working in random industries like industrials and gaming companies. I didn't even know that gaming was actually like casinos. I thought it was some random, I don't even know what I thought it was, but I was working in these random industries in leverage finance. And I was in SF though, and I obviously wanted to join a tech company out of my 2 years, but it was very hard to break in. And so I ended up joining SVB in its corp dev group. And in that group, it was a group that would invest out of the balance sheet of SVB into companies that would be part of that tech ecosystem and that they felt would be helpful to potentially back and potentially become a bigger company. It was a pretty interesting role. I liked it a lot. We got to evaluate a lot of different companies in different industries, ended up investing in several fintech companies, as well as also companies that like a boot camp type company that would help tech workers get jobs or non-tech workers get jobs in tech. But I guess from that experience, I learned that the tech industry is definitely something I want to be in. And I was able to parlay that role into my first job in tech. So definitely a good experience there. I think the last takeaway I had from that was I wasn't meant to work for large corporations, because SVB was decently sized back then, but it was just, everything moved so slow and I didn't like it at all. I like working at a fast, quick pace, getting stuff done. And just pretty much what startups are all about. I'm sure you know that too, but having that sense of fulfillment where you're able to see things get done every day and you can hang your hat on something and just look and see what you accomplished that day. It's like, oh wow, I actually did a lot. Versus like when I worked at large banks, or even like I've worked for a public tech company before too. And it's few and far in between where you're able to hang your hat on things that you've done. Sometimes like you're actually like, I don't know if you remember in school, in elementary school, when things would go by so slowly, you just look at the clock and it's still like ticking by so slow. But that's how I felt working on like a larger company. Whereas working at startups, I'm like, oh, it's already 5, it's already 6, already 7 p.m. Where did they go? And you're just so busy and doing stuff all day. And you feel that sense of accomplishment, which is super important to me.
Yeah, absolutely. That's awesome. That definitely resonates. Did you, on a side note, did you foresee any of the challenges that SVB would have had years later? It's funny you said they moved slowly, because it felt that during the downfall, people said they were moving too fast and not having as much oversight as other banks.
I don't know if I foresaw it, but I sat on the same floor as that group that was doing all those things. And yeah, my boss's boss was the CFO that was in charge of that, who became the president. And yeah, it's definitely something I didn't foresee. And it sucked too, because I had a decent chunk of stock. And my wife's like, hey, you should sell it. When I left SVB, she's like, no, it's already gone up like, 4 or 5x since I've been here. It's only going to continue to go up. And then it still did go up when I left, especially during ZIRP, right? But then, when everything went to kaput, it sucked, but it is what it is, right?
Yeah, absolutely. Well, she was right. I'm sure she reminds you.
Yep. She's always right.
Yeah. So you're also a pretty prolific angel investor, from what I can see and what I know. Can you tell us more about that and what you look for in terms of the business you invest in?
Yeah, definitely not prolific. It's just something I like to do, and I really enjoy working with earlier stage companies. So if I ever come across a company that is in my wheelhouse and I feel like I can give some benefit to, then usually I'll put some money in there. One example is a company that recently got off YC. They're in the B2B healthcare space. I don't work with any healthcare companies now, but I have in the past. And this company is sort of like is like a 3.0 version of one of the tech companies I worked for in the past too. So I could definitely see the problems that they're solving for, because this health company I worked for in the past, half of their business was SaaS, half of it was professional services. And the reason why it was PS was because these hospital systems, they have so much data that it's really hard to wrangle all that data, put it into nicely packaged data packages, and be able to digest it. And this startup that I've been getting to know recently, they've automated the whole process using AI as well as their data processes that they have in the background. And so it's mind blowing to see how much they've been able to automate that PS portion of what this public health company that I've worked for in the past is charging so much money for. And so companies like that, where I had experience in that healthcare B2B SaaS, I've worked with a lot of the go-to-market teams for these healthcare B2B SaaS companies. I feel like it's like a match that makes sense, where I can potentially help with some of the advice that potentially might be needed for them to hopefully continue to be successful.
Yeah, awesome. And if you're open to sharing, how's the portfolio going, and how many years back did you start angel investing?
I started maybe 4 years ago or so.
Okay.
Have had, I think, 2 or 3 exits so far. Nothing huge. Nothing huge yet. Some are going really well though, or at least what the CEOs tell me when I see them. He's like, okay, I'm glad you invested back then, because we're going really well. We have a bunch of acquisition offers, but I still haven't seen anything yet. And this was like, this is like 4 months ago. So we'll see, right?
Okay.
But yeah, I think when I invest in these companies, I invest knowing that I'm probably not going to see that money back. So it's more of cherry on top for fun. And hopefully something comes out of it. But it's not like I'm investing, majority of my wealth into it. It's just a small portion that I'm fine losing, right? Because at the end of the day, it's startups, super risky. If I wanted a return that's more in line with the S&P 500, I invest in the S&P 500. A lot of these are just, moonshots, home runs, or hopefully those grand slams.
Yeah, well, absolutely. Well, you got to be in it to win it, right? So, and you're only 4 years in, so it's early. So, have you had any horror stories you can share, or any interesting stories from exits or even fundraisers across your career?
Yeah, one of the companies I worked for, they were looking at getting acquired by Strategic, and we didn't know, but they were also talking to a competitor of ours too. And so we thought pretty highly of ourselves. We'd raised a lot of money. We're doing very well compared to this competitor. This competitor was probably like maybe a fourth of what we were doing in terms of revenue ARR. And so we thought of ourselves pretty highly. We commanded a pretty high price, and it went far along in the process, but then at the end, they bowed out. We didn't understand why. And then we found out a couple of months later that they acquired our competitor for a lot cheaper price. And then what ended up happening from there is that we didn't end up executing. We didn't do that well, and we ended up getting sold to this competitor that the Strategic already bought about a year later for a lot lower price than what we commanded. And I guess from there, I think complacency was obviously important too, where we didn't really understand how well our competitor was doing. Even though they're smaller than us, they're going at a lot quicker pace, and they're just eating our lunch money from the smaller SMB mid markets. And we weren't focused really much there. We were trying to go up market and focus on the enterprises. And so just under our nose, they were growing a lot quicker than we expected. And they ended up being the one that acquired us through that original Strategic about a year later after they bowed out. So that was definitely a good experience there in terms of not getting too complacent, because we thought we were the 800-pound gorilla in the room, when in reality we probably were for the time being, but we weren't focused on that competitor, like just eating our lunch.
Yeah, wow. So how late in the day was did the deal go the other way? Near the close?
Yeah, we spent a lot of time. We also had one of the big 4 bulge bracket banks helping us as well too. It was like it definitely cost a lot of money from both sides too, because they had to pay us since he bowed out, but it definitely took a while. Like, yeah, at least 4, 5, 6 months due diligence, because once you sign a term sheet with a PE, that's when the real work begins from like a due diligence perspective. They're going to be grilling everything from like your financials, your contracts, trying to get meetings with your current customers. Like that's when the real work begins. Just getting the signed term sheet is maybe with like VC investors, there's not much afterwards. Like I raised 50 million before where the VC doesn't even look at anything after they sign the term sheet. And then sometimes are in that instance later, they're like, wait a minute, you guys do pilots? This isn't the company I invested in. I was like, well, if you actually asked us for some of the contracts, and you'd see that we did do pilots, right? So like yeah, it's definitely different. PEs, once you sign the term sheet, then they'll dig in and they'll look through everything. So it's, yeah.
Absolutely. So it feels like the VC market definitely has changed. The PE market's been changing recently. How do you see things changing moving forward? You've mentioned the big shift towards efficiency from a much earlier stage.
Yeah, for sure. Efficiency is definitely important. A lot, like we still see a lot of funding on the VC side, but it's very bifurcated, right? The best companies are still raising at very strong multiples, but the middle of the pack or the middle 80%, they're still facing a lot of scrutiny on efficiency and burn, right? So if you're not like a super fast growing AI startup that's grown from 0 to 10 million within the past like 2 months or so, I think it's harder to raise funding. So, but I think overall, we'll continue to see the market reward disciplined companies where founders have clean bucks, good unit economics, and optionality. I think that'll be the best option. But I do think that we'll hopefully see a lot more activity soon, because interest rates, it looks like they're going to drop pretty soon, at least in the US with what's going on with Trump and stuff like that. So hopefully we do see a lot more liquidity events happening soon.
Yeah, absolutely. People have been saying that for a while, but the maths always plays out eventually. So all the dry powder is going to come into play. Well, Son, this has been fantastic to talk to you. Thanks so much for coming on. I'm sure the audience have learned a lot of great stuff.
Cool. Thanks for your time. Really appreciate it.
Thank you.